Welcome to our coverage of the Bank of Canada's interest rate decision, increasing interest rates by 25 basis points, but importantly signaling that they are now on pause, ready to wait and see the impact of their increase in interest rates. Combing through the statement and the monetary policy report, they note that restrictive monetary policy is slowing activity at the same time that they are seeing progress on inflation. If you've been listening to our conversation, we've had a great panel discussion with Andrew McCreath, Earl Davis, Jim Thorne. They are still with us now. There's a diverging opinion on where inflation and rates go from here. We've got two camps. We have one camp that says we're done with inflation, rates can come back down, and another that there's a risk that inflation cools but not as much, and rates need to go higher after a pause. So with that in mind, because we're not going to re-debate that again, what do you do with your money? How do you invest if that is your view? Andrew, you're in that camp that you're worried that inflation is not a straight line down and that rates could have some upside risk.
Yeah, the road to 3.5% core PCE in the States is visible, but going down to the low twos is much tougher. And when you look at the financial markets are pricing in 50 to 60 basis points of interest rate cuts by the Central Bank of the United States by the end of 2023. I believe that's the key reason why the S&P 500 is trading at 17.5 to 18 times earnings. That will only go higher once earnings estimates go, call it 5% lower, with fourth quarter results that are coming out right now. And so the question is Jim right or is Earl right? We don't know. I think clearly goods pricing is going negative, but the question is on the services side.
But so you're also signaling that maybe the market is too expensive, even with the pullback.
Oh, bottom line is yes.
And stock market.
I've never seen markets bottom at 17.5 to 18 times earnings, let alone 18 to 18.5 times earnings. The second point is investor behavior suggests we have not reached a market bottom. Investors are still buying pullbacks. You haven't seen cathartic trading volumes. You haven't seen the retail investor get frightened yet. So the valuation, the outlook for earnings, and the simple fact that investor behavior does not suggest we've seen a market bottom.
Yeah, I wouldn't say the market is expensive. I'll say equities are expensive. We really like corporate credit. You know, the yields have picked up significantly, more competition for equities. They're higher up the capital structure. And we like investing in companies that allow you to win in most environments. The ones that could pass through inflation, have solid balance sheets, talking utilities, your groceries, and some telecoms, right? And in that environment, it's all about yield, 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 yield. I would say on the duration front, you don't want to extend duration here. It's very tough to own long-term bonds with 2% handles when you have 6.3% inflation prints. So short-cap credit in the 2 to 3 year area provides you great protection and yield and income.
What are you doing? You have a different view?
I'm on the...
You're out in the wild?
No, this is just following the standard playbook, right? Yeah. So the Fed's going to cut. We're going to pause. We're going to cut. Long duration assets in the fixed income market have already moved. The trade in the fixed income market and its sovereigns is the short duration, right? It's the 2 year, right? And the 2 year, the way it's acting right now is suggesting that the Fed will cut. Two, that when that all gets priced in, then it will eventually move into the equity market. And you saw that last week when you saw tech move. The long duration trade will over. Everybody is piled in to staples, which is the inflation trade. Kimberly-Clark came out this morning and saw a 7% cut in volumes. Yep. The consumers are pushing back. Things are going in the right direction. So I would be on a pro-risk environment.
So I'll push back on that. And
that's on the good side again.
Well, yes, it is. But I do want to take the point of you're saying, what are we hearing from companies? And most of them are signaling that softness, whether it's Kimberly-Clark, whether it's Procter & Gamble, whether it's on housing. D.R. Horton also talked about this, whether it's Boeing today, whether it's Microsoft services. Mm-hmm. There, I'll throw in Microsoft, signaling decelerating cloud growth. CN Rail also signaling slower profit growth. So we might have this situation where inflation is coming down. I think these companies are telling you that, but that's going to squeeze profit margins, and that can't necessarily be good for stocks.
Exactly.
Okay. Well,
you can't have your cake and eat it too.
So there, what do you say to that?
That's the consensus Wall Street, Bay Street view, and I disagree with it.
Is it consensus?
Yes.
But the market
doesn't say
14 times earnings.
Exactly.
Boeing is up $100 from the October low. D.R. Horton, who you're basically talking about, is
Yeah.
up 50%. The stock market is a forward discounting price mechanism.
So where's the S&P going to be at the end of the year?
4,800.
4,800.
Yes.
Wow.
Okay, because 4,000 has been a real stubborn lid.
Leverage up.
On the S&P 500.
As I would
What
say-
takes it to 4,800? Rate cuts?
Large tech, good earnings.
So back to the good old days?
So the multiple's going
Good
back to
earnings.
23
I mean, these
times.
companies are not telling you that's what's coming down the
so
pipe.
here's the game, right?
Okay.
Labor Day is going to happen. They're going to pause and then they're going to start to cut. It's the 1994-1995 roadmap, okay? In September, these guys will come out and say the S&P will be at 21, and in 2024, S&P earnings will be somewhere between 260 and 275. All the Bay Street and all the Wall Street strategists will come out and put a 5,300 on the S&P, and then we'll have the FOMO trade, right? That's exactly how this is going to. What is funny is that when I sit there and go pause and cut in prudence, we're an outlier, right? Here's the thing, and I'll put this on and I'll timestamp. Oliver Blanchard, the former head of the IMF, came out with a paper yesterday. And you know what he says what we're staring at?
What?
Secular stagnation and deflation, right? So what I'm trying to say on an island is that it's deflation and slow economic growth. We are going back to the pre-COVID environment.
Okay.
Okay?
All right. I'm going to leave it there. We have to end scene because we've got a commercial to hit, and we've got Kumutha Ramanathan live on Bay Street for a reaction, and then we'll get the final word from the panel on the other side of this break. Stick with us.